the way we're going to do it too.
Yep.
We're going to record it, and then we can just send the recording out, man. That's the beautiful part of doing it. So I'm always encouraging people, if you are a content creator, do a Facebook Live, do an Instagram Live. If you can't, just go on the street and put a microphone up, create some content, and it's going to be there for life. But more importantly to that, bring some value. Bring some value. So this is why I reached out to my brother. And now when I say that, you guys are probably saying, you always call everybody brother. No,
we literally did grow up together.
I'm talking sandbox, brother. You know what I mean? So here we are, brother. But yeah, so what I wanted to do, Erwin, because a lot of people who may be listening, and even if they chime in after the fact and they're listening to the broadcast on a repeat, say hi to Maria. And they're listening to this after the fact. Can you just give them a little background about yourself? How did you get started? How did you where'd you grow up? And let them know a little bit about, because I know that you're a professional investment advisor, and you've been at this for 30 years or so now. About 30 years. So can you just give them a little background about yourself?
So I mean, as you know, growing up in the DC area, it wasn't always easy for the family. So just growing up in a household, hearing all the stories about money, as I'm sure everybody hears growing up. And just to me as a child, man, I remember dating back to my teenage years, man. I had 3 jobs at one time. I had a paper route in the morning, early in the morning, paper route, McDonald's in the evening. Then Mike Ash and we used to clean toilets at Andrews Air Force Base. So I was all about money, man, and not necessarily to hoard it. My goal was to teach people about money. I said, when I grow up, man, I want to be somebody that teaches people about money, because I kept hearing all the bad things about, I don't have enough money, we can't do this. Yeah, money was the constraint. So my thing was, I want to learn about this thing called money, so I teach other people how to make it work for them. So that was kind of my charge in life as a young adult, man, and then went on to college. And basically, went to college to play football. Really didn't know what I wanted to major in. Then one of my professors said, "Hey, man, what if you ever thought about owning your own business? Become an accountant, because they will teach you all about business." And so that's how I came in.
So
yep.
Let me stop you real quick. So now,
yes,
you said that you were playing football. Can you talk a little bit about so I obviously you played in college.
Yeah. So I was blessed to have the ability to get a college scholarship, and then had a great college career, and then got picked up by the New York Jets upon graduation in 1989. I was signed as a free agent, and then didn't make the team, got cut that fall. Wow. Then I took a year off because I had a knee injury, so I got myself right. Then I went back to Canada and played with the Argonauts for that year. I played during the preseason. Toronto Argonauts. So that was a blessing, man. But then I knew, my calling in life was going to be to help people again, teach money, and that's when I started working with athletes. Spent a year, about 4 years with an accounting firm, Ernst & Young. Got my CPA, because remember, I wanted to be an accountant, own my own business, etc. So I'm still on that path. And then finally, as I was an auditor working with Ernst & Young, I decided, man, this is not really what I like to do. I like talking to people so much and being around people. I think that's my sports background. You know how it was. We grew up together playing sports. We were always involved with people. And so that's what took me to the love for financial planning. So in '94, I went to work for American Express, moved back to DC, went to American Express in Bethesda, became a financial advisor. And then that launched my career as a personal financial advisor.
Okay. So you've been a financial advisor, obviously, ever since, and then you were going from Ernst & Young, American
Express, then Merrill Lynch, and
Merrill Lynch,
and since 2009,
and then Ernst.
That's my current status, and then I went to graduate school in 2013 just to kind of retool my skills. But I still maintain my business, and I've expanded my business now, become a franchise owner. But my day-to-day is still investing in financial planning, helping people retire, save money, etc.
So now I know you went to University of Richmond for your undergrad, and then went to what was your
graduate studies? Was Emory University here locally in Atlanta. Yep, the Goizette School. Yes.
And
that 20.
Okay, so got your graduate at Emory. So
Hey,
man, we talking to the best of the best now,
I just
brothers.
want to be a vessel. Yes, sir.
Yes. Okay. So now, can you help us out, because there's a lot of turmoil in the markets right now. A lot of people are nervous on what's happening in the market. It's going up, it's going down. Can you just share with us and just give us a little guidance,
yes,
especially for new investors who are really not sure about how much I should put in the market? What should I put my money in? Should I put it in stocks? Should I put it in a bond? Should I use mutual funds? Is there all of this terminology that they're hearing, and a lot of it is going over their heads? So can you kind of like break it down on just on an elementary school level, so we can understand how the market works and what's happening?
Great point. So I think money. To your latter question about how the market works. So one of the things that drives the market is what we call our economic cycle, right? And so you talk about what's going on in the economy. We just came out of a long period of prosperity where things were really good. People were making money, getting jobs. We had a great run in terms of the economy growing. Now there comes a time when there's too much, we call demand, and not enough supply. So this is economic theory, but basically what's going on now is there's a lot of money in the economy. People are making good money, but there's not supply for a lot of reasons. We had the COVID situation. We had some disruptions there. Then we have the situation in Russia. A lot of things are restricting people's ability to get basic needs, food, automobiles, things like that. So it's creating an inflationary environment. And so as a result of the economy doing so well, the cycle that we're about to go in now is we have to slow it down so prices don't rise too much. As a result of those changes, you see the effects in the stock market. And so what I try to get people to understand from an investment standpoint, you say, well, how much, what's going on? We try to get people to understand the stock market is considered a long-term opportunity. When I mean long-term, at least have 3 years to invest before you need the money. If you don't 3 years and preferably longer, 10 years or 20 years, you really shouldn't be dabbling into the stock market right now. So what I encourage people to do first is look at your emergency needs, because part of the frustration that people have is they use the money that they're going to need for emergencies and invest in the stock market. And when things go bad, when the market drops, that creates the emotional situation. That creates the stress, because that's money I need to pay my car payment or to pay my rent. I had it in.
Oh, say that one more time, bro. Say that one more time, so we can
when
really
people ask me the question about what to invest and how to invest, I first ask them a question about, do you have your emergency cash set aside first? Because it's like building a house. Think about your foundation. In order to build the nice rooms, you want to build a solid foundation. In your financial life, your foundation is your emergency needs. I'm talking about money that if you lost your job tomorrow, or you accident or something where you needed $100 or $200, do you have the ability to go get it out the bank? Or can you access it on a credit card? You want it to be in cash at your local bank, credit union, etc. You should have at least one to 3 months of your monthly expenses set aside.
Well, and when you say our monthly expenses, you're saying our totally monthly outlay, meaning house, car, insurance, food, gas, everything that we have put down on a monthly basis. Kind of, and I think with most people, where they falter is they don't even have it written down, so they don't know how much.
That is a great point. So normally, what I do in that case is when I have these conversations, it's just tell people, give me a ballpark. So here's a good example. Use 1 month of your salary. Okay. Everybody knows how much they make. Just take two paychecks, and whatever that total comes up to, that should be a starting point for how much money you should have in the bank. Just do it that way. So I tell people, just use your paycheck as a guide. And then 2 times, just 2 paychecks should be your 1 month of savings. That should be a goal of yours. And once you are able to do that, then we can start talking about investing. And if something happens or somebody needs some money, you can always access your cash at your local bank. And you don't have to worry about your investments that may be losing money in the present time. but I don't need it right away, so it shouldn't be a major concern. So getting back to your original question, so once I am comfortable that the person has cash reserves, that's what we call it, money, then we can talk about any excess. And so let's just use an example. If you got $1,000 a pay period and you got $2,000 that you in your bank, that means you have 1 month of your monthly income set aside. It's a low number, but we say 1 to 3 months, but let's just stay 1 for conversation. So if you can do that, then I would say, okay, Mr. and Mrs. Client, if you've got at least money beyond the $2,000, then we can start talking about investing. And are you going to be okay leaving it alone for at least 3 years? Ideally, you want to leave it alone longer. If you can pass that test and say, yes, I have cash reserves, yes, I can leave the money alone for a period of time, then let's talk about how to invest. And then we can talk about what types of things you want to get invested in. And normally I ask people to think about what they do every day. Where do you buy your shoes from? Where do you grocery shop? Where do you shop at the store? Some people answer with Macy's. I like Nikes. I buy Disney. I buy Apple. Then let's try to look at those companies. So let's invest in what we know. McDonald's is another choice. Yes, good investment. And so that's where that's how we start the conversation. Then we get to a dollar amount. What I try to tell people is come up with an amount that you can live with every month, doing what we call systematic, adding to it every month. Even if you start with $25 or $50, it doesn't matter. Just get started is what we say. And then you can buy what you call a mutual fund, which is a fund that invests in those companies you just talked about, McDonald's, Coca-Cola, Apple. You can buy into those every month if you want to.
And here's the crazy part, because and someone, if you're listening to this, I'm glad you said as far as first you get that base down, and then you can on it based on your comfort level. Because when I first heard about investing, to me it was just too much. I'm like, wow, I have to have saved up, $30,000 before I can start investing, and it overwhelmed me. So when you broke it down and you said the $25 or the $50 or the $100 or the whatever it is that you're comfortable with.
Yeah, because you want to get started. It depends on your audience. For my younger clients, I just want them to get started, because the younger you are, the better off you'll be. Time is one factor that contributes to how you make money in the markets. Time, the amount you invest, and then being patient, of course. And then if you're fortunate enough and you saved into your retirement plans, the concept still is in play. If you're concerned about the market, I would ask the first question, why, first of all? And then if you say, well, I'm afraid of losing money, but when are you going to start needing the money? Well, I'm not retiring for 20 years. Okay. So, I mean, the fear is real, but let's be realistic. You won't need it for another 10 or 20 years. You really should not be concerned today, unless you don't have that cash reserve in place. Because what I have learned in my experience, that a lot of us, and maybe it's through because we're learning about investing, a lot of people use their retirement funds to deal with emergencies. Short-term emergencies are disrupting long-term plans. And so what I try to tell people is try not to do that. That's why you want to work with someone like me, because you want to start learning how to save and build your foundation stronger to protect your longer-term investments. And so that's what we're talking about.
Well, for those just jumping in, and you're just joining in, we're having a conversation with financial advisor Erwin Matthews, and he's just teaching us on a basic level how to be a better investor. So, so let me ask you this, Erwin. Okay, so we've gone and we have our basic
1 to 3 months.
2 months. 1 to 3 months. Okay, we have our 1 to 3 months savings, and now we want to and you know how people like, tell me the hot stock.
Yes, they do.
People come to you and ask you that? Tell me the. And typically, what is your response when they ask you, where can I make $1 million next month?
I told you you could take $1,000, and in a year it would be $2,000. Would you like that return? And everybody says what? Yes. But what if I said in a year it could also be 500? And so if they say no to that question, they don't want a hot stock. And so what I try to get them to understand, hot stocks are relative. It really depends on how much risk you're willing to take, what you consider hot, because I may answer with Apple, which would be considered a good stock. It may not, grow 100% in a year, but it'll grow a nice rate of return. Or you could do some of the cannabis companies, some of the new companies that are coming out that are making marijuana, things like that. Some of the green energy companies, those may fit the criteria for hot stocks. So we could talk about something like that. What I try to get a gauge for is the investor. You as the investor, what's your style of investing? Everybody's different. Because what Frank thinks is aggressive may be somebody else's conservative. You know what I mean? So what I try to do is make sure I understand the behavior of the individual I'm dealing with, and then we can point you in the direction. Because we want to make sure you can sleep at night. That once you make the investment, that you're not calling me saying, what happened? You didn't tell me I was going to lose money. We have that conversation up front. So when you do make the investment, we make sure you can sleep at night. It's fitting in your overall plan. If an emergency comes, we don't have to worry about you calling me because we already talked about that. We can let this market, like the downturn that we're experiencing now, let that ride out, because next spring, next summer, we should be okay.
So it sounds like instead of me as an example, instead of telling me the specific stock to buy, you're kind of giving me an overall a bundle of like you said, like a cannabis or like an electronics tech. You're giving me an overall view, but not a specific. And that's kind of, would that not be kind of dangerous for me to try to kind of play Russian roulette?
I mean, I don't know if I call it Russian roulette. I mean, it could be money that you're willing to gamble. And I say gamble because it may be a new company. Okay. And sometimes the new companies don't make it. I mean, just because they're public is no guarantee that they'll survive. So what I try to tell people is once we build the portfolio and you're comfortable, then I would come back and say, Mr. and Mrs. Klein, okay, let's look at that money that you're okay losing, because if we can fit that criteria, then we can go and, take some high risk and go for something really, that's the idea. Wow, you got to be okay with losing it. And what I mean by that is, if the 1,000 goes to 200, it's not going to really disrupt what you're doing. But it may go to 2,000 too. So to have that opportunity for it to grow high, you got to take a lot of risk.
So I have to be comfortable with my 1,000 going to 500, and like once you ask me that question, and I say, yeah, I'm comfortable with that 1,000 going to 500. Then you say, okay, these are the type of stocks that we can probably look at. And as a new investor, will we be looking at maybe stocks or mutual funds, or how would that be determined? Or that's going on how our first conversation
great question. So I would suggest all new investors do what we call diversify. And what I mean by that is you want to own more than one individual stock. And so you can do that through an investment vehicle called a mutual fund, which is a company that pretty much puts a fund together that will own McDonald's, that will own Nike, that will own Macy's, that will own Disney for you. And you're $50 or $100 a month, you're buying a portion of that fund. So you have fractional shares in all those companies. So if somebody's doing really bad, you own 10 other companies. So you won't see your money going down a whole lot. But when the economy's doing well and everybody's spending money, you're probably seeing your money grow. So yeah, great point. So through a mutual fund is a great start. And then once you build it up, you can get more aggressive and go individual companies and things like that.
Now, the craze was happening now, and it's coming. Talk to me about the cryptocurrency and the what is it crypto? It's a couple of different names. Cryptocurrency.
Yeah, I mean you got Ethereum, Bitcoin, and all of the, like you said, all of the cryptocurrencies, like 200 currencies out there now, coins, I guess. So I mean, I view that as, I mean, it's still part of an investment, the investment world. It is very risky from our perspective. And what I mean by that is, I think Bitcoin in its best has been up to $70,000. Now it's down to 20. That's what I mean about risky, yes. So you got to be okay with that, because I think over time it will probably be okay. But normally in the early stage of a new idea, a new investment, it will be what we call very volatile. It'll be up and down like we're experiencing. And if you watch Bitcoin and Ethereum and the crypto coins, they kind of have moved in line with the stock market. So the market is down right now. So are the crypto coins and the Bitcoin or cryptocurrency.
Wow. So maybe I want to get into the
Say it
Bitcoin now
again.
at 20,000.
So
maybe I want to get into the
excellent
Bitcoin
point.
now
So
at 20,000.
that is the point I really wanted to drive home. You actually want to think differently than what the news is saying. When the stocks are dropping or the Bitcoin is dropping and you still believe in the idea, it actually may be a great opportunity to start buying. So you're right. So that's the conversation we try to have.
See, yeah, because I'm coming. I always typically come from the real estate background, and they say, well, you know, the market is going down, housing prices are going down. I'm like,
we
man,
say
that's great.
compared to going to the store, seeing your favorite merchandise on sale, what would you do? You probably would buy more of it. If you take that mindset to the stock market, you'll make money in the market. It's really that simple.
Yeah, so I'm just waiting now for it. I mean, I know it's not happening now, but if the market went and the houses started being $100,000 again, you would just grab it and not even think twice about it, because we kind of know what's going to end up happening in the end, because the stocks are working the same way and we're not as familiar with the stocks. I think that's what holds us back. And the more we hear this conversation that you are having, I think the more comfortable people will feel that, okay, yes, the stocks are going down, which means to me as an investor that it's a great opportunity and a great time to do that.
That's, I think we need to think, just as you mentioned, this would be a great time to start building cash and not necessarily waiting for the right time, but actually starting. If you got extra money, this would be a great time to start building a portfolio of stocks or mutual funds, starting your investment program, because I think there will be more times where there will be more down days in the near future. So there's some time to continue to do it. But I'm with you. I think we should shift our focus. If you're interested in investing, this is a time to really kind of, we talked about getting your list of companies that you've been looking at or hearing about. It's a great time to start buying them because they're cheap and they'll be cheaper. With the idea that in the next 3 to 5 years, Apple will continue to do well. Google, all those companies are cheap. Amazon, Tesla, you can get all those companies at bargain basement prices today.
All right, well, I have 3 years. Gabby's in the 10th, 11th, 12th. Yeah, I have 3 years.
Some 10, but I say if you can start with 3, I just want to get you in the market. And that's what you can give me 3 years, we can usually get you a nice return on your money.
Phenomenal. Now let me ask you about because you touched on a little bit about your other business that you have as far as your taxes.
So I do taxes as a CPA. So I do primarily small business owners and high net worth individuals who may own corporations, LLCs, investors, real estate investors like yourself. Those would be individuals that I work with personally. And then I own franchises that do taxes for individuals. Traditional non-complex individuals. So it'll be traditional, maybe household, has some kids, they may own a home, but no business income. Credit.
You said, but no business rose up for a second.
We don't do businesses under my franchise.
Okay, no business under your franchises. Okay, all right, yeah, because when you and I think I was telling my son to maybe to come to you, get under your wings, learn how, because he's taking the business.
Oh yeah, I'm gonna let him get his feet wet, then I'm gonna take him to lunch. I figure I'd let him get acclimated and then call you and then see if we can do lunch.
Yeah. and because I told him, I said, well, son, I said, well, you as far as the basketball career, it's not going to happen, but you can make friends with the person who can have a basketball career, and then you can expand and show them how to invest their money.
Yes,
an agent. Learn how to be an agent, whatever.
Man, I think, not to get off the topic, but you touched something that's near and dear to my heart. I think athletics for pro athletes is, to me, a catalyst to be business owners. If you think about it, the amount of money that those guys make in a short period of time is basically their seed capital, Frank. And I keep saying I'm gonna write a book. That will be the book that I write about how athletes can use sports as a catalyst to really elevate and propel their careers to where they'll never have to worry about money again. They could hire guys like you and me who've got business backgrounds, who know how businesses run, show them how to use their millions of dollars while they're still playing, invest in a business, build you a team, and then when you come out, you can continue to make your $1 million a year in your enterprise. That's, I think, is the real opportunity for athletes. So to the point that you're making, but for wisdom, that's a great idea. Great.
Wow. And again, just not off topic with this, but as for your book, one of the ways that I found is have someone like myself interview you in regards to in regards to your book. Have 7 to 10 different topics, question you about it, and then we just literally record it just like we are now. Recording, you can go over to Fiverr,
no way.
just recording,
really?
They'll transcribe the each
no
interview.
way. Okay, well, I'm gonna call you when I'm ready to do it for sure. Thanks for the tips on that, man. But I tell you, I think, and you know this, getting back to the topic, they say more millionaires are created buying real estate and investing in the stock market. The market, to me, continues to be a tool to catch up, because there's a race of people. You know, we have not always been investing. I think the 90s is really kind of the first generation of investors. But I still see the market as a way to play catch up. If you don't have time, start putting the money in, take a little bit more aggressive posture, and you usually can catch up and be okay.
Wow. Okay. So, and for those right now, and because typically I can say, you know, the people who follow myself and Maria in our market, and I was looking at our demographics. Our demographics are the early 40s to mid 60s. The oldest one is 60, and probably the early 40s typically. And our demographics, I think, is 55 or 60% women and 40% men who actually follow us. Now let me ask you: Do you find that men or women are typically more?
Great question. And I would say women are more apt to seek advice. And I think it's probably 50-50, because I see just as many men doing it. A lot of them do it on their own. But the women just appear to be more open to advisors. So normally when I meet a couple, it's through the female. You know, she either will have seen me somewhere, somebody would have made a recommendation. You came to my company and did a speech, and she'll bring the husband to the relationship. Or I will run into, you know, my brothers, and then they all want the hot tips. Hey, man, I got this. Can you do this for me? And then, you know, I try to get them to do planning, and then, you know, they're impatient. But, hey, man, I love that both of them are in the market, but the men usually will try to be on their own. Women will try to seek the advice. But together in the couple, in the relationship, as long as an advisor is present or somebody who knows kind of what's going on, it usually works. And sometimes if the guy's out there on his own, he'll still come on board. He'll just kind of use me more as a sounding board. But that's kind of how I see how people enter my practice. Yep.
Wow, phenomenal. Yeah. Well, man, Erwin, man, I truly
oh, man, appreciate
your time. So is there anything else that you would want to get across to and a person who wants to invest, if they want
to, they can find me on the web at onesourceadvisor.com, or they can always call me, of course. But www.onesource advisor, onesourceadvisor.com, and I'm on LinkedIn as well. But certainly they can reach out, man. I'll be happy to do a Zoom call at any time. You know, don't let distance be a barrier for us. But my thing is just to tell people, these will be one of those watershed moments that when the market drops or you hear this disruption with the oil or whatever, you have to start seeing those as opportunities. And if you really want to know how to make the money in the market, you want to buy it when things are really low, just like Warren Buffett does. If you listen to what he says, and some of the great investors of our time, they say buy it when there's blood in the streets, when it's ugly, and when people are running, you want to start buying. And so that's the idea.
Before I let you go, a book
referral for I would say there's a newspaper out there, Investor Business Daily, and Investor Business Daily is a publication that's it's a newspaper, and then he wrote a book about investing. O'Neill is his name. That's a good one to start with, because it teaches people, you know, the day-to-day, what's going on with the market, but it also teaches you how to pick stocks, and that's what most people want to know. They want to kind of know what's going on. So he would be I forget the first name, but his last name is O'Neill. He publishes the Investor Business Daily publication. That's the one I would recommend. That's always been a good read for do-it-yourselfers or people that's working with advisors. Yes, sir.
I love it. I love it, brother. I love it. Yeah. Well, I'm going to let you go, Erwin, and we're going to get back on. You know, maybe we can do this once a month.
Do it,
man.
You
know, just to come on, get the information out to the folks, because I truly believe the more repetitively that we hear it, the more confident we're going to be in doing it. And because I don't want it to be foreign. I truly don't want it to be foreign to them. I want them, and then the more they get into it, the more questions they're going to have. Yes. They're going to lean more into it. And be like, hey, you know what?
Yeah. Well, I mean, mostly everybody's involved now, whether they want to be through their work retirement plan. So it's happening. But to your point, they need to know what's going on.
Yeah. Absolutely, absolutely, and and then we can probably talk about the 4K IRAs and break that all down on our next time getting together. Hey guys, so truly appreciate you. This is the BS of Entrepreneurship podcast.
Sir.
This is the home edition. The home edition. Partner Frank P, my man Erwin Matthews, One Source Advisors, and remember, you change your perspective, you change your life. When you change your perspective, you change your life. When you change your perspective, it doesn't take much. $25, $50. Let's get the base started. Please reach out to Erwin Matthews. And guess what's going to happen, guys? You're going to change your life.
Take care, bro.
Peace.
Thank you. My pleasure.
Hey, thanks, Erwin. Later.